Good morning, beta. To see you on the screen. Hello, Kushi. Kushi also here. Anybody would be there in the evening, or I'll be all alone? Vedner is also here. Yoga Lakshmi here. Good morning, people. So good to see you all. Shravant, good morning. Chalo, people. Yeah, good morning, Guruji. Oh my God, that's too big thing to say, man. Guruji is different. Okay, let's start, people. Let's start. See, yesterday's question. Started recording or not? You're recording. See, yesterday's question that we were solving, question number 18, right? Half part of that means part 1 we have done. Part 2, yet we have to do, yet we have to complete. Okay. So what we will do is first we'll complete that part 2, question number 18. Shall we? Yeah. Let's start then. I'd asked you to note down the concept of Gordon dividend discount, right? Must have noted that. Okay. I opened all the files. All the files finished. Very good. Actually. Okay, see, talking about this question, guys, talking about this question. We had completed part 1 yesterday, right? Part 2 is yet to be done. So we'll first discuss that so that the question is complete, and then we will go to the next concept. Okay, instead of leaving the concept halfway, midway, first complete that question and then we will go to next question. Okay, let's start then. See, what is told in the second part of the question is define what marginal cost of capital means. What additional capital that you are raising, its cost. So how much the company is planning to raise. Hello people, remember marginal weights? We did talk something like that. You remember that? Book value weights, market value weights, and marginal weights, or that is additional capital to be raised. So we'll use that proportion, simple as that. Let's read it. See, define the marginal cost of capital schedule for the firm if it raises how much? 750 million for the new project. Okay, this is altogether for a new project. Now, whatever is already over here, nothing to do with it. Okay, we are raising for a new project, we are raising a separate money, right? The firm plans to have a debt of 20% of the newly raised capital, guys. So out of this, 20% is going to be debt. So obviously it is understood that 80% has to be what? Has to be equity, right? Right, people? Everybody understand? Yes, fresh equity, correct. Everybody understands that much? Okay. Now, what else is told? The beta of the new project is 1.4375. I hope yesterday we had a detailed discussion about beta, right? What is beta? It is a sensitivity index of a particular security with respect to market. Right? See, earlier the beta of this company earlier, the beta of this company was 1.1875. Now with the new project, probably the risk is more. Okay, why this is more? Probably with this new project, what must be happening? The risk must be on a higher side. That's why shareholders must be demanding higher returns. You understood? See, we are not required to justify that much. Whatever is given, get the CAPM formula, substitute. AR, right now, RF plus RM minus RF multiplied by beta. But just thinking, putting a logic behind it, what must have happened? So see, if you see these numbers, then it becomes visible. Okay, fine. This is 1.1875. This is 1.43. This one I'm talking about. These two I'm talking about. Why increase? Probably the new project might be a little more riskier. So, okay, the debt capital will be raised through term loan. Okay, it will carry rate of it will carry interest rate of 9.5% for the first 100 million and 10% for the next 50 million. So what, guys? Forget all other things now. Other things I mean to say related to this question. We are not going to talk about the old reserves, old preferential capital, nothing doing. We are talking only about the valuation of cost of capital for this new project, and that's what it is, marginal cost of capital. So let's do that first, and then we will go to the next concept. Let's start with our video. Solution to classwork question 18 part 2. Calculation of marginal cost of capital for what? New project. In simple words, we are writing, guys, this is for our reference only. Don't write this in exam. So I'll do it a different color. Hello, guys. Did you understand this? Only for the what? Only for the new project. Nothing to do with the existing capital structure. Am I pretty clear to this? Yeah. Okay. Fine. So let's start. So how much is the capital required? 750 million. Total capital requirement 750 million. You know now, guys, we need to put two parts out of this. What is told? Firm plans to have a debt of 20%. So that means 20% debt. So we need to understand that 80% would be what? Equity. Okay. So 20% will come to 150 million amount wise if we speak. So it will be 150 million. So here it would be 600 million. Fine. Even in this 150 million, see what is told. It will carry interest of 9.5% for the first 100 million. So again, I have to put a bifurcation over here. For 100 million, rate of interest is going to be 9.5%, correct? And for the balance, 50 million, I'm very clear with my words. Rate of interest, guys. It's not cost of capital. You know, people, you're able to understand what I'm saying. Rate of interest and cost of capital are two different things. Correct? Cost of capital is what? Effective cost, post-tax cost. Well, rate of interest is just how much interest that we pay without giving a consideration of tax effect. Correct? Yeah. So for the 50 million, rate of interest is going to be 10%. Okay. And let's see, the 600 million is going to come through equity. That's it. So no further classification required over here. Okay. So that means what, friends? Now, if I want to calculate the WACC for this project, that means I'll have to calculate three costs. Understand? I have to calculate three costs. This is like cost one, correct? For this one, cost two, and cost three. You understand? Three costs we will have to calculate, right? Yes. So let's do that. Yes, date one, date two, and equity. Fine. So before we make a table, we will have to know this cost. Now, what we do is normally we put a table, right? You remember what we always do? We put a table, keep everything blank, things ready, and then we in the working note we calculate the KDK as per the requirement and post it in the table. So table is always ahead of everything, visibly first. Okay, let's start. Source, cost, amount itself will act as what? Weights, and then right. So the sources are going to be what? Debt one. Let me write rate of interest 0.5%. Debt two, rate of interest 10%. And else equity costs we have to find, but amounts we already know. Correct now? Amounts we already know. Debt one with rate of interest 10% is going to be 100. Sorry, not cost column, amount column. Amount is going to be 100. Debt two with rate of interest 10%, it's going to be 50. And equity is going to be 600. So we already know that how much we have to raise. We have to raise 750. That's what we already know. So let's start calculating one by one. Leave some space over here. WACC KO, total product upon total weights. Okay. For the sake of writing, I'll give one more line and then we will start. Okay, note number 1. Cost of debt KD for debt 1. Okay, guys, anywhere, see such a small question, 4-line question is this. Anywhere details of redemption are given? No, not given. So what to do? Small formula. Everybody understood the question now? First of all, you need to understand the question to answer it. So details of redemption are not available. So we will stick to small formula. KD interest 1 minus tax upon what? Net proceeds. Okay. So what is the rate of interest per year? 9.5%. So it's going to be 9.5% of how much is the amount that we are taking? 100 into 1 minus. What to do with tax rate? Guys, tax rate not given. So it's the same company. No? This is the matter to be discussed out and attended by common sense. It's the same company which is evaluating one more possibility. So tell me, already in the previous part of the question, is the tax rate given? Yes. If it's the same company, then tax rate should also be the same. No? Should I claim that tax rate is not given? It will be a rubbish idea to do. Okay. We just have to see it's the same company evaluating one more project. So shall we follow the tax rate given in the earlier part of the question? Agreeable to all of you? Don't just nod your heads because I say. You agree with this, right? Okay. Net proceeds are 100, guys. What happens, since childhood we are used to write percentage upon 100, no? The moment net proceeds are right 100, immediately visualization only changes. Huh? I'll be calculating percentage. No, the net proceeds are 100. Nine point five into 165. Get 0.06175. So what we should say? Shift 2 digits over here. So 6.175 is quick. Rounding off is becoming national issue. Some sort of very soon government will declare rounding off as a national calamity. Normally, government comes out in helicopters, it's an army, etc., to help all those affected by floods, earthquake. How much? 6.175. So guys, come on. 6.1. 1 what? 8 na? Hare, Someshwar, good morning, Munna. Someshwar joined little late or what, right? Oh, you joined before. Oh, okay, noted. Working note 2. Cost of debt KD for debt 2. Again, small formula we have to go with. What did Pukal say? Pukal said something. Pukal calculated. Pukal busy talking to family members. Hello, hello, Pukal. Hello, Pukal. Pukal emergency. Hello, Pukal. Pukal paying attention. Pukal calculated or not? How much? Did you get 5%? No. What is the cost? 10%. 6.5 is what you should get. 6.5. Ashreya, why bargaining so much, Ray? Where is Ashreya? What is happening? You divided that further. You have gone crazy. 10%, right? 10% of 50. Good idea to write everything now. Or Darshan Jain also getting 3.25. Ashreya, you're not alone. We have people having same thought process. Where is Darshan Jain? Can I have your Darshan or Darshan Jain? No. Are you out there, dear Darshan Jain? Only reply in chat box. Sorry, I don't come on screen. Sorry. I divided by 100. Arey, come on, there are two people divided by. Arey, I got it. I got it, Yash. I got it. You divided it by 100. That's why the rate went half. No. 6.5, you know? Okay. You know what happened? People put 100 over here now. So they like this number very much. So they put it over here also. We like it. Wrong or right is not our problem. That examiner will see. Okay. Chalo, let's see what people have done. Huh? This comes 0.065. That is 6.5%. Okay, fine. I wish I could complete it over here only. Working note 3. Yeah, KD 6.5%. Very good, guys. I can see your answers. Huh? Hina, Krishna, Bharat, Pooja, Prakash, and Narasi also. Okay, I see your answers. Don't worry. Good that you are calculating and good that you are responsive. What happens is either I see you people on video, that is source number 1, and the second source is I get your answer in the chat box. Right? These are the two sources which confirm me that you all are alive. Let's calculate K for this. No? For that one, that two done correct, but then we have to calculate K for 600 million, right? And then we are doing K by what? K by CAPM, huh, guys? Only what, guys? Beta. Oh, that option is always there. Correct, Ashleya. Ashleya is saying sleeping with eyes open. Yeah. Quite possible, quite possible. Mind is always in the sleep mode, you know. Hello, guys. For CAPM, we'll use that formula RF plus RM minus RF multiplied by beta. What is changing for the project? Beta. What is changing for the project is beta. What about RF RM? So that will remain same. Earlier given the question, risk-free returns and market return, that is market risk premium, is already given in the question. So that is not going to change. Only what is going to change, the project that we plan to go for with the 750 million, it is supposed to have more risk. Because it is supposed to have more risk, what will happen? Obviously, it will have a higher beta. The rest of the things will remain same. Okay, so let's go ahead with that. So KE is equal to RF plus RM minus RF multiplied by beta. So what is told in the question? What is the risk-free rate of returns? Government of India Treasury bonds is 5.5% plus. And see, I told you that the question does not give you RM. The other question gives you RM minus RF. The market risk premium as much as 8, correct? Wherein specifically beta of this project that you are going to undertake is going to be a little more risky, right? So the beta is little on a higher side, 1.4375. Okay, so what you know now how to respect mathematician, right? First BODMAS, don't first add 5.5 with 8. First 8 with 1 point whatever. So 8 into 1.4375, whatever it came. To that I add 5.5. Then the final answer is 17%. I hope everybody has got this answer, 17%. Yeah, I saw the take 3 what 11.5%. 17% is the correct answer, guys. K 17%. Yes. I got your answers, Deepika, Prakash, Yogeshwar, and Penrasi, Hina, Vinita also. Good people. Good. Yes, Bharat, who else answered me? Or you're unanswered. Oh, we also answered. Okay. Good people, good. So now we will go for KO. Where is 3? You did not add RF, Ray. I did not got the correct answer, 17. Okay. Fine. So what are you waiting for? Let's substitute all these values over here. Correct. Det 1, we got 6.18. Det 2, we got 6.5. And equity, we got how much? 17. Right. Then you know what to do. Multiply 100 into 6.1. So 618. 6.5 into 50 is 325. 600 into 17 is 600 into 17 is 10,200. 10,200 plus 325 plus 11143. So this is going to be 11143 upon 750 divided by 750. So you get 14.14.8. What after 8? That's a big question for the day. 5 or 6? 6. Okay, great. 14.86, because we've been struggling a lot on rounding off. Yeah, I'm genuinely planning to take one extra lecture only for rounding off. Just practice rounding off. Five plus 1 6. Very good. Rishabh is always innovative. Okay. Later over. Fine. What do I do? Tell me. Tell me so much. What do I do? When this becomes a rounding off, becomes a national issue. It's just a simple thing. See the third digit. If it is 5 or more, add one more to the second digit. If it is 0, 1, 2, 3, or 4, do nothing as we normally do nothing in the lecture. Just sit idle. So, since yesterday I realized that rounding off has become a big issue. Like I need to contact World Health Organization, IMF, maybe United Nations, UNICEF, all international bodies to focus on this question. What happened, Ramakrishna? Don't cry, dear. We will sort out this one day. Yes, people. I hope you will have understood what I'm talking, what we have solved. Similar thing. Only thing what we did, you understand now. We have calculated for a altogether new project. So whatever has happened is the existing capital only for the new project. I hope the picture is clear, right? Okay. Fine. So what we will do now, I know we have to calculate, we have to go with that screenshot you want, Sumesh. Sumesh, like I thought, you know, uh, like plants need sunlight to survive, like that. Someshwar needs screenshot to survive. Derive energy from this. Without screenshot, nothing in the life, sir. Okay. Someshwar, chat later. First, take screenshot. Okay, listen. We obviously plan to go with the next concept, but just to bring to your notice, what happened? CAPM questions should be a little more clearer to you. So just taking a simple, making you understand simple. This is not a big question, just discussing once and then we will continue. Okay. So what we say for CAPM, what is the formula that we have derived? We say it is RF plus RM minus RF multiplied by what? Multiplied by beta. Okay. Is it really? Actually, I read your message. Okay, now pay attention to this. Please, everyone pay attention to this. See what we say, CAPM is what? RF plus RM minus RF multiplied by beta. Okay, so just the analysis of this formula, because I felt yesterday that you did not have many sums on this. So only once you calculate and then nothing happens. So you might not be able to recollect what exactly happened in this formula. Seriously. So I'm discussing for 5 minutes. Okay. So see, what is this? What is this RF, guys? What is this RF? See, understand this is risk-free returns which investor gets. Okay, right? Specifically speaking, what is this whole thing? What is this whole thing? RM minus RF. So RM minus RF means what? I would say this is, wait now, don't chat, don't put anything. Just listen. Listen to me, guys. I understand. I I, I agree wholeheartedly that people write in the chat box. That is good that they want to be participative, they want to be enthusiastic, which is very good sign. They're not dull. Okay, but for some time you listen to me. Okay, then you reply. Your answers are not wrong. Just clarifying the view. Okay, so this is expected extra returns over and above market returns. Market returns is what are expected extra returns. That is why we call it, that is market risk premium. Okay. And then what is beta? Beta is a this is sensitivity index of a particular, we can say what, of a particular share. Okay. Right. So see, if it is like this, that see, RF is 5%, means by investing in the government securities, investors is like peaceful, no risk. I'm going to get 5%. Okay, so these are simply what, risk-free returns. Okay, let's say RM is 11%. Okay, so these are like market returns with risk. So what is the market? So what is the market risk premium? Market risk premium is 6. 11 minus 5. Right, people? I hope you understand this much. Now see, if I prefer not to take risk, I will buy government securities, 5% ease of life. Okay. If I'm of that category that without risk, I cannot have my food, I cannot digest the things, I'll go for the market. Right? So I know if I step into the market, I'll get this much extra. This extra is what is attracting me. Na? If I step into the market, I'll get that 6% extra. That 6% extra is attracting me towards the market. Correct, friends? Right? Okay. Now the question arises, in which security I'm investing. Okay. So if beta of given security is 2, let's say it's 2. That is what? That is the security is what? Twice as risky as market. Risky, you can say, volatile, you can say. Okay. So how much I will ask as an investor? Okay, I would say give me that 5%. That I want only. That I easily get by investing in the risk-free market. Okay. So I want that. So I will ask for twice the market risk premium because this security is twice risky. I will invest, but I'll ask for twice the market risk premium. So how much I will ask and how is it justified? Okay, fine. Then KE would be I want 5. That is for sure. That is my RF. Plus the market risk premium twice. What is this? This is RM minus RF. Okay, but I just don't. I will not be just see if the security had a beta of 1, then this was fine. If the security had a beta of 1, then this was fine. I would have reached. See, if I had multiplied this by 1, then what will happen? I'll reach the market premium, market returns. Okay, but now the security that we are talking about is twice as risky as market. No, so getting one time of the market risk premium makes no sense. You will say, no, I will invest in this business, no problem, but I want handsome returns because the risk is too high. Then that way, what will happen? 2 times the market risk premium, that is 12, plus ordinarily risk-free returns. So I have to get that too without doing anything. If I invest in if I invest in risk-free securities, I'm going to get 5% as such. So how much total should I get? This 6 into 2, 12, 12 and 5, 17%. Guys, you understand this? Right? This explanation remains in your mind now, right? Okay. Just note it down. Done, people? Yeah. Okay. See, question number 17 is of a similar pattern. Okay. So that we have to solve, but I think we have already written for the dividend discount model of Gordon, right? Correct. So I'll just brief you on that and then we will continue. Okay, fine. Let's start. After writing, yeah. When I say RM, Ovia, when I say RM, what does the RM means? Market returns. Then market is of you or me or Shree's market or Hariharan's market or Anjani's market. Whose market? Market is for everyone, right? So market returns is applying to all the companies. Company wise, what will change? Beta will change. Correct? No? And all of us will buy government securities. So your government and my government is different or same? Same. So if suppose as we know now, post office issues what? Those national savings certificates. Hello? Shh. Guys, post office, India, no? Hello? Everyone from India? Good. So you know post office, it has a red color thing. Good. Good. See now all of you like, oh, what is you talking? Post office, post office. Don't look like that. So it issues those national savings certificates and all, right? Can I call them as a risk-free securities? Absolutely. Government promises that money to us. So that is same for everyone. So RM and RF are same for everyone, for every project. Under particular market, now you think of opening one tire manufacturing unit. Okay. And then you think of starting a mobile industry, mobile manufacturing unit. These are two different things. So you can't compare market returns of mobile manufacturing units with that of a tire manufacturing unit. Even within the same industry, market returns is an average value, so which will remain same. Fine. So let's go ahead. So we were talking about this dividend discount model. I think you must have understood that there is no big thing. While writing also, yes, while writing also, you must have realized that this is just a manipulation of the formula that you already know. Correct, no, people? So I gave you for writing. While writing, you must have realized that no big deal is done. How we calculate K? D1 upon P0 plus G. Okay, shift that G on this side. It becomes K minus G. Adjust. What happens? You get this answer. Okay, how you can calculate P0 in that case? Then P0 would be D1 upon K minus G. Important part. See, this is a dividend discount model. This is used for what? Estimation of equilibrium price. That is a possible or expected price of a security in what? In near future, guys. Please understand this. Okay, this is a possible or what expected price in the near future, right? Okay, can anyone, future is certain or uncertain? Uncertain, people. So there is no certain thing that this will happen only, right? People allow, see, people purchase investment plans of 20 years, investment plans of 30 years, and they die on the next day. Uncertain. So what is the guarantee that this price will come? Mere probability is quite high, right? I'm not giving you on a stamp paper that this price will come. Everybody invests in market with that view only, right? So this is an equilibrium price which the market should reach. Okay, fine. What are the assumptions? See, the assumptions are very simple. KE once estimated water wells constant. That is fair enough. Okay. Then KE has to be greater than G. Okay. Now talking about the theoretical logic. Why KE has to be greater than G? Because KE minus G is there in the denominator now. If KE happens to be the smaller, then what will happen? Answer will turn out to be negative. So price of the security becomes negative. So what does that mean? You buy the security, I will pay you. Price of the security becomes negative means what? Suppose you apply to the company for new shares. Price of the security is negative. So they give you the share and they give you the money also. Which is you all understand. See, when sometimes I think that competition begins now. Right? Um, price war begins, right? As it happened in the telecom sector a few years back. Right? Recharge of 100, then recharge of 80, then recharge of 50. Then it went on to the last step. What? Free service. Reliance Jio gave free service for a considerably long time. Then I was always thinking, now what should be the next step of the competitor? And to buy the recharge, they'll start paying you 5 rupees, then start paying you 10 rupees. Negative pricing. But obviously, we know negative pricing is not possible over here. That is one mathematical logic. What is the second logic? See, the second logic is the real logic. Means what? See, what we are saying. What is K? K is cost of equity. Correct, friends? Cost of equity earlier, long back, ages ago, we had written. You remember, guys? Ages ago, we had written. What? What ages ago? 2 lectures ago, we had written. Okay. What we had written? Basically, it is certain or uncertain. Certain or uncertain. Returns are guaranteed or not guaranteed? Not guaranteed. But still, companies have to give some returns. Yes, companies have to give some return considering market situation. So which is based on what expectations of the equity shareholders. So we have written like this that the expectation itself become cost. Okay. So this cost, this expectations will be always higher than growth. Means suppose you give 5% growth in the last year, then what will happen? Equity shareholders will expect what? More than 5%. You can compare it to your academic performance. If a child is barely passing, understand, I'm talking about academic performance. If a child is barely passing, 35% on the boundary, 35 and a half, 35. Sometimes 34, then school promotes by giving some extra marks for notebook, handwriting, good dress, uniform, nicely polished shoes. School gives some marks for some reason. Good tiffin, very delicious tiffin, whatever, and makes it to cross that border. So suppose that child starts getting 40, then parents are like, but 40 now. Next you should try for 50. Growth. Expectations are always higher than growth. See, talk about company. Suppose company declares 15% dividend. So next year people will expect more than that. Okay, will it happen in any annual general meeting that shareholders come and tell the director, yeah, a lot of hard work you have done, too much dividend you have given, take rest, and please don't give any growth. Sorry, we don't want it. You must be tired by now. Take a holiday, please. Is that going to happen? No. See, whatever you do last year, whatever growth you give last year, that becomes a benchmark. That at least that growth has to come. Yes or no? If you go below that, then you are not performing good. You have to give more than that. So K will be always greater than G, guys, logically also. It's not only about mathematical equation. K is the expectation of equity shareholder, which will be always higher than what? Always higher than the growth factor. Did you understand this? Okay. Fine. Come to question number 15. Shall we? Let's read it. Beta coefficient of target limited is 1.4. Yes, easy. Understand that before I teach you, Mr. Gordon, first I have to teach you beta. That's what you've already done, right? Company has been maintaining 8% growth in dividend and earnings. So let's go on collecting the data. Beta 1.4, growth is 8%, 0.08. The last dividend paid, guys, the last dividend paid. Hello, reply me. What to do? What to call it? D1 or D0? D0. Everybody understands this. Like this is the hey, what is this? What is this? Laksha, what is this? What is this? D0, 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 guys. D0 is 4. Okay. Then return on government securities is 10%. I'm very sure that you know this. RF is 10%. Yes, correct. With right. And returns on market portfolio is 15%. So that means RM is now RM is not a market risk premium. Market returns are given. Yes, now premium is 5%, but right now what we are given as market returns we are given. Okay. So current price is also given. Current market price of one share of Target Limited is 36. This, what is this price prevailing in market? Okay. Yeah. What has been asked? What is the equilibrium price per share of Target Limited? Okay. What you've been asked for the equilibrium price. So see, guys, from this data, what we can do, what we discussed, equilibrium prices. Okay, fine. Let's put it on paper. This is question number 15. Solution to classwork question 15. Okay. See, we know how to calculate equilibrium price. D1 upon what? KE minus G. Now, if you analyze the data given, D1 you can easily find D0 plus growth. Right? Growth is already given, right? What is missing? K is missing. So can we find K? Answer is yes. Okay. So here find KE by CAPM, capital asset pricing model. So KE would be RF plus RM minus RF multiplied by beta. Okay, so we know that RF is 10% plus RM is 15 minus 10, and the beta of this particular company is 1.4. Right, people? So 10 minus 15 minus 5 into 1.4 is 7. So 10 plus 7, that is 17%. Okay. Now the next thing, equilibrium price. As we can say, expected price. What we discussed. E0. Hello, now people will pounce on me. Sir, we know the price. It is given in the question, 36. Guys, 36 is the prevailing price in the market. What can be the possible price according to the formula is what we have to find. That is called as an equilibrium price. What is expected price? Today I step into market, I open my app and I see the price 36, right? But what is the expected price? So it is D1 upon KE minus G. First of all, we'll have to calculate D1. D1 has what? D0 plus growth. D0 is 4. 4 plus 8%. 4.32. 4 plus 8%. 4.32. Okay. So guys, P0 is what we need to know. Okay. This is 4.32 upon KE, 17%. So 0.17. Right, this will become easy for you to solve, guys. KE is put as 0.7, sorry, 17%, 0.17. And growth is how much? Growth is 8%. So put it 0.08. Got my point? So this denominator is 0.09. So 4.32 divided by 0.09 comes to 48 rupees. Did you guys get this answer? Right? So as per our calculations, what should be the market price of this security? 48. What should be the market price? 48. Correct. What is the prevailing price? 36. So what should we do? Suppose I'm calculating. I calculated this price. I'm calling my broker. Hello, what is the price of this share? Ray? So it tells me 36. I calculate 48. Ooh, what do I do? Should I buy or don't buy? Buy or don't buy? Buy. Simple. Hello. In the you go to have you gone in your whole life? Okay, whatever number of years, right? I have almost more than double the number of years with me. How many times, whenever you have gone to the shop, fine, it is written on the product MRP 48, discount offer 36. Then what do? You buy, accumulate, buy so much that after coming home, you realize 90% of the things bought are of no use. But still, you buy. Fine, that's a different story. I'm not out to discuss that today. I think everyone has experienced this in the life once at least. See, when this whole process started now, when we, our generation has experienced everything, stepping into bank only in the morning hours, 9 to 2, no computer, handwritten, you write na JF, LF in your transactions, narration you write, in ledger you write na in journal you write LF, in ledger you write JF. You have seen that. People open the ledger like this. Right. You've seen that. Okay. So that was the time we have seen. Then the FDI, and then liberalization, privatization, and then these big malls, then this discount culture. It was not there earlier. So one of the very famous such super shop, only for the first time kept a huge discount offer, and everybody was so amazed. The people in our area went there. It was so overcrowded, so mismanaged. They had to call police. It was like a mini rioting. Police had to do lathi charge. So see that, yeah, this is the old story, guys. Old stories. So see, I told you now, we've seen the both phase. That's what I told. Now today for you all, it's very normal. Okay, fine. Buy one, get one free. Buy two, get four free. Buy two, get five free. Buy nothing, still get everything free. Okay, fine. Anyway, so what advice we are giving, guys? Buy now, let him buy now. Yeah. So, conclude. Right. Expected price 48 rupees. But current market price 36 rupees. That is, it is available at a discount. It is a profit making opportunity. Therefore, why? Therefore, what? Therefore, purchase at current market price. Purchase at what? Current market price. So this part is very much clear to all of you guys. Okay. See, the question was two parts. No, first you find the equilibrium price that we have done, and what is your advice? That also we have done. Okay, fine. Okay, you all come to question number 17 now. Come to question number 17. Now, people, before I start, let me tell you, this is a now whatever WSEC questions we have discussed now. This question number 17 is of the same type. Fine. This question number 17 is no different. It's of the same type. So we are reading it. Okay. After reading, what I will do as we are doing right now. I'll share the screen. We'll read the question. Fine. Then I'll again stop share. I will solve, you will solve, but you will not see my screen. And then we will check our answers, whether I'm right or wrong. Okay, so let's start. So XYZ Limited has the following book value capital structure. This is the book value capital structure. Fine. Now equity capital of rupees 10 each, 15 crore. Okay, fine. So let me do one thing. Let me write number. How much would be the number of rupees 10? So shall I say 1.5 crore? Wait, how people wait. Solution, complete solution of 15th question. Somebody is asking me, hey, who's that? Muthu Parmeshwari. Note it. Done. So let's go ahead with question number 17. You're welcome. Yes, we were to talk about equity capital. So we discussed that numbers would be how much? 1.5 crore. 11% preferential capital in shares of rupees 100 each. Fully paid up at par are 1 crore. Guys, what will be the number? Will it be 1 lakh? Correct. Then retained earnings, that is reserves and surplus. 13.5% debentures of rupees 100 each. This is 10 crore. So how much? Divide 10 lakhs. Okay. And then there is a term loan. Fine. Okay. You understand, people? It's all about writing the correct numbers, right? Okay. Yeah, if we want everything in crores only, suppose we want, like, no, no. So putting the zeros would be heck. Okay. So this is the 1.5 crore number. 1 lakh. 1 lakh becomes how much crore, people? Reply. There are two answers, 0.1 and 0.01. See, if you're not very sure, now what you should do, if you're not very sure, I'll tell you. This is 1 lakh. I hope you can read that. And this is 1 crore. Don't laugh. Okay. If some people don't know how to do it. So this is 1 lakh divided by 1 crore. Even able to see? Correct. So 1 lakh would become 0.01 crore. And 10 lakhs would become what then? 0.1 crore. Okay. The next expected dividend on equity shares is 3.60, guys. Next, now see, I can't find wordings more clearer than this. Crystal clear. Next expected dividend. What is that? D0 or D1? D1. Sorry, the question is, sir, what kind of question you asked? D0 or D1? Now people are saying second option. Well, no, I should do D1 as the first option. Okay, let me change. D0 or D1? Okay. It happened like that. That meme circulate now. Classwork, very online exam, very easy. Which one of the following is red? Then red is written in green color and green is written in red color. You have to select the one out of it. So this is for sure what B1. The dividend per share is expected to grow at 7%. So this is G. Market price per share is 40. So this is P0. I think all components are given so that I can easily make out KE. Okay. Then preference stock redeemable after 10 years, guys. You have to go with the big formula. Is currently selling at rupees. This is rupees 75. So I can say this is net proceeds. Debentures are redeemable after 6 years. Even debentures are redeemable after 6 years. And they're selling at 80. This is net proceeds. Tax rate is 40%. Required. Calculate the current weighted average cost of capital using what? Book value proportion and market value proportion. Guys, what to do? Solve it two times. Right? First, as usual, calculate now how many sources of finances we have: equity, preference, and what? Debentures and what? The term loans. Right? When you do book value, right? When you go with book value, you know what to do. Right? You will follow book value, then that time equity capital you will also take and returns. Oh yeah, let me write like that. This is the 1, 2, 3, 4, and let's say this is fifth. This will not come every time. When you go for book value weights, retained earnings should be taken. Correct? If you're going for market value weights, then no retained earnings. Right? You have to just follow the market value given. right? So let's first calculate the costs, okay, and then use book value weights once, and then use market value weight second time. Fine. Okay. And then this is as usual. Define what weighted marginal cost means. Only the same thing. Marginal cost of capital. So it's going to raise 10 crores next year. Okay, and then the conditions are given half this way, half that way. Okay, this part we will discuss later. First, we will complete this part. Okay. Hello, people. You understood the question? Okay. See, if you think that there might be some changes in your solution later on, what to do? Solve it in the rough. Okay. If you're confident what is to be done, then solve it in fair. Otherwise, you can solve it in rough. I'm going to stop share right now, so you won't be able to see my solution. So I want you to practice. Basically, the thing is that okay, I want you to do a little on your own. So let's start. First part we have solved as given in the question. First part we will solve. Okay, first part. Then we'll solve second also, but just following normal, like first part then second part. We're solving everything. Happy? Equity, preference, retained earnings, interest. Everybody solving now, guys? Okay, okay, continue. Stop reading after 10 minutes. Hello, people. Are you done with the book value proportions? Yeah. Oh, acha, okay, okay. Started posting the answers also. Okay. Uh, uh, but very few answers have come for book value proportions. Those who are done, yes, I could see your answers. Without part 10. Means if people are still in WIP, okay, I will wait. Good, very good people. So let's give a look, see whether we have the same answer or not. Book value proportions. 13.93%. Right? At the end, we will share everything again. Don't worry. Don't you worry. Thank you, Lakshma. Thank you. That I'm very happy to see that I'm doing correct. Let's go with the market value weights. If you're already done, then wait for me. Yes, I will show all the answers. Shreya, I will show all the answers. See, what is the point? What is the point hiding the answers from you? Tell me. So at the end, I will show, as usual, the whole screen. You can take photograph, take a screenshot, whatever. This is 40. Okay. Reflections. Reference capitals. Comprises debentures. Debentures are being sold at debentures are being sold at 80. Guys, done? Okay. So let's check our solution. See, first of all, go with the book value. Yeah, I will keep the whole thing on the screen. So like you can take a photograph also. See, I hope everybody got the same book value. Guys, confirm 13.93%. Yes, now? Good. Very good. Good job done. Those who are still taking screenshots, like if you're taking them, then do it so that I can scroll further. I'm scrolling further up. Obviously, market value calculation didn't take much of time. What is important is going with the correct number of shares, right? Second thing, when market value of equity shares is taken, we all know what we have to do. We don't have to consider reserves separately, right? That's what we have written long back. Remember, guys, over here, what note we have to write at the end? Achha, sir, no much of calculation. No, because I'm just going to copy the same cost. No, cost is same, guys. What is going to change? Only the market value, the weight is going to change, right? And what note we have to write? While calculating KO at market value. While calculating KO at what? Market value. Reserves are ignored. Were assumed to be included in what? Included in market value of equity. Right, friends? Clear to here, guys? Everybody has got the correct answer? Okay, if you have not, then please, in case there is some mistake, probable, see, in market value, two possibility of mistake. One, you took reserves also, forgot to ignore the reserve. And second possibility is what? Calculation of number of shares. But I think that possibility is rare because that particularly I had earlier discussed with you before I gave it to you as a question. So dealing with the part two of this, shall we read part two? Yeah, let's do that. Okay, question 17, part 2. What is written here? Define weighted marginal cost of share, means like same thing, additional capital. If it raises how much? 10 crore next year. So company plans to raise how much? 10 crore extra. Okay. The amount will be raised by equity and debt in equal proportion. So guys, out of this, 5 would be debt and 5 would be equity. Okay, fine. Company expects to retain 1.5 crore earnings next year. Okay, what do we mean by that? Available for investment 1.5 crore, right? Hello, people. In the earlier question, you remember in one question we had defined marginal cost of capital, where 7 lakh rupees were required from fresh issue. Out of that, some 210 was available from the reserves. So what can I say over here? 1.5 is already available from retained earnings, right? So how much will be the proceeds of fresh issue? Shall it be 3.5? Yes. Okay. 1.5 is reserves. So 3.5 is fresh issue. Additional issue will result in the net price per share being fixed at how much? 32. So guys, you understand, you will have to calculate KE again because the rate is changing. Date capital raised by way of term loans will cost 15% for the first 2.5 crores and 16% for the next 2.5 crores. So here also there are two rates of interest, half by 15, half by 16. So almost going in the same pattern, almost going in the same pattern. The marginal cost question we had solved, Masco Limited. So let's present this also. This is question 17 only. This is part 2 now. So all part 1 and part 1A and B. This is part 2. People done calculating or calculating? Still calculate. Today we become a silent movie. Good, good. Calculate, calculate. Yes, calculate. One question to be solved on full on your own is good idea. It's confirmed. Did you get the same answer? 13.78%. Yes. Smart people. So see, you can solve on your own also. Right now. That's important. People are done till here. Yeah. Let's take a quick break of 2-3 minutes and then resume back. Okay. Let's resume. Hello everyone out there. Good. What is written, Ray? Someshwar, corrected now? Okay. Okay. Fine. So let's go ahead. What is that? Solution of 18th is required. Who is this? Sri Nandini. I don't see these people in my whole life. Solution of 18th. What was 18th? This is 18th part 2. Let's do screenshotting at the end. Huh? Because at the end also people crop up. I want this, I want that. Huh? So screenshotting ceremony at the end. Let's first continue. Let's come to question number 9. Okay. We are starting with question number 9. Okay. Let's go through it. Hmm? Let's understand. ABC Limited has the following capital structure, very important, which is to be considered optimum. Means what? The best capital structure. Hello? What is the management's thought process? That this is the best capital structure. The combination. Now, if we convert this into percentages, say 30 and 10, 40, 40 and 160, the total is 2 lakh. Right? Correct. Na? So if we convert this into percentages, 20%, 20,000 would be 10%. Right? So this would be how much? This should be 80%. True. This should be 5%. And this would be 15%. Correct, people? Understand? What am I saying? This is considered as what? This is considered as an optimum capital structure. What does it mean? The company is very happy following this capital structure. 15% of debt, 5% of preference, and 80% of equity. What does it signify, guys? That in future also, whenever we have to raise some money, unless told in the question, will we follow the same capital structure, 15, 5, 80? Yes or no? Yes. Do you understand? Sure? Huh? Okay. Okay. Now let's see further what is called. The company share has a market price of 23.60. So somehow when I turned off the screen and volume no, for taking the 2-3 minutes break, by mistake I think the brightness got reduced. Suddenly I'm not able to read anything. What is going wrong? What is going on? Then I realized that the brightness has gone too much low. So, okay, fine. So let's read people. Next year's, okay, what we should call this company share is a market price of 23.60. So we call it P0. Next year dividend per share is 50% of 2017 EPS. Hello, like this, like this. See below. What is 2017 earning per share? 2.36. So 50% of this here. Come on. 1.18, right now. So D1 is going to be 50% of 2.36, that is 1.18. Hello, is the condition understood? Okay, okay, it's very simple thing, man. No big deal. And the following is a trend of EPS for the preceding 10 years, which is expected to continue in future. Guys, trend in dividend help you to calculate what? G, growth factor, right? Hey, hello, we have done questions like this. 5 years trend given, 6 years trend given, then we find percentage change. We have done that. We have done that. Yes. Okay. So for G, follow trend. Okay, people have got answer of trend also. I think trend is very simple, right? 10%. Okay, we'll see that a little later. Company issued new debentures carrying 16% rate of interest. I think this is pretty clear. They are making new debentures, and then the current market price is also given, net proceeds. Okay. Preference shares rupees 9.20. We should write at. We should write at. Rupees 9.20 were also issued with annual dividend of. So what is this 9.20? Again, it is net proceeds. Company is in 50% tax bracket. Calculate after tax cost of new debt, cost of new preference shares, and cost of new equity shares, consuming new equity from retained earnings. You know, people, what they are trying to tell you. They are trying to tell you that you calculate KE, but basically KR. Excuse me. You understand what they are trying to tell you? That suppose company doesn't make any fresh issue only. Use only what? Retained earnings. So fine, now we know now that retained earnings is nothing but what? KR is equal to what? K. So if I tell you calculate KR, so what will you do? Oh, sir, we will calculate KE only. Exactly, that's what they have told you. You calculate KE. Fine. So I think let's do part by part. Okay. So first we will tackle with this. Calculate cost. After what if these words are not there? They don't just use these words after tax. They just say calculate cost. Calculate cost. Always cost for us is what? After tax cost only. Correct. Na? So that words are just to add to little confusion, right? Nothing else. We solve as usual. Okay. Fine. So let's start. This is number 9. Any space left? Part A. In that first part, cost of new debt. KD. Hello, people. Details of redemption given or not given? No, no, not given. So KD would be interest 1 minus tax upon what? Net proceeds. Okay. Interest is how much? 16%. 16% of 100 1 minus, what is the tax rate given in the question? 50%. The company is in 50% tax bracket. Minus 0.5 divided by the net proceeds. The net proceeds are 96. So 16% of 100 is 16. 16 into 0.5 is 8. Right. 16 into 0.5 is 8. 8 by 96. 0.08333. So 8.33%. Saket, good man. Wait for some time. Let us calculate. The second sub question asked is cost of new preference shares. KP. See, people again, no, they're not giving you any details of redemption. So you have to just like do like this. Preference dividend upon what? It proceeds. So preference dividend given in the question is how much? 1.1. And net proceeds are how much? 9.2. 0.1 divided by 9.2. 11.956. So let's make it 11.96%. Right? Are people? Is this 11.96? Yes, no? How much more rounding off? Saket, where are you? Saket. Correct. If you follow that, then what? And as simple as that, you will get it 11.96. We're calculating cost of new equity, but basically for KR. So K is what? D1 upon P0 plus G. So we'll write over here. Now we wrote in our book, but we'll have to write over here. That is 50% of 2017 EPS. I mean, we need to write over here, guys. We wrote in our book is fine. What is P0 given in the question? $23.6. Okay, hello guys. Growth is sure 10%. Right, so we can safely take 10% as a growth, right? But that cannot be assured, right? Pattern as repeated is correct, but we have to calculate. I know, but we have to calculate every time at least. Okay, people. So we've got all the three values. So part one of the question is answered. I mean to say A, 1, 2, 3 is answered. Let's calculate B. Let's calculate B. Now, very important part. What is asked in part B? You're asked that marginal cost of capital when no new shares are issued. Marginal cost of capital when no new shares are issued. Now, what does it mean, guys? It means that additional capital's cost when no new shares are issued. Now, sir, how is that possible that you don't issue new shares? Listen to me, guys. Excuse me. Listen to me. Do not put any ideas in the chat box. You know what happens now? I've told a number of times. Once some ideas come in your mind, then it is difficult for me to remove those ideas. So I love blank students. Like, what is happening? I love less students. Okay, sir, you told, okay, fine. If you pre-generate idea, means not every time I tell you this, jokes apart, but listen to me. Here, conceptual clarity is very important because I've already started getting different ideas from students. Hold on. Listen to me first. That's why I was writing. Marginal cost of capital when no new shares are issued. That means what? Additional capital cost when no new shares are issued. Now, what does this mean? See, company can make use of retained earnings, right? That is the first thing. So people are saying that only preference and debt. How is that possible? Sir, it's a fresh issue, no subsequent issue. Only preference and debt is possible. I agree with you all. But at the beginning of the question, you have seen something called as optimum capital structure, right? 15,580. So company will respect that ratio. No? Whenever fresh issue they will be doing, they will be respecting that ratio, 15,580. Hello? Are you on the receiving side? Are you receiving? Are you listening? Ah, okay. So first thing is that company make use of what? Retained earnings. Second is what? Company will maintain optimum capital structure ratio. Understood what I said? Okay, so marginal cost of capital when no new shares are issued. It means that company will make use of retained earnings. So see, guys, how we are going to write? Source, cost, amount, which is what? Weights. See, in every question I make it a point to write amount what? Weights. Correct? And product. Now suppose the marginal, as we discussed, okay, it will be what? It will be a mix of all these three. Okay, debt, preference, debt, preference, and equity. Basically, equity is what? Retained earnings. Company has retained earnings, no? Okay. So what will be the cost for debt? How much we calculated? For debt, we calculated 8.33. For preference, we calculated 11.96. For equity, we calculated 50. New capital's cost But sir, new capital's way amount is not given. Is it told how much amount to be raised? Read that questions line. Read that questions line. What is written? Calculate marginal cost of capital when no new shares are issued. Marginal cost means only additional cost. So don't tell me that no fresh issue is done. Marginal means what? Additional means additional issue is definitely happening or not happening. Happening or not happening. What's your opinion? Happening for sure. Okay, sir. Agree. No happening. Na. So we're taking debt preference and equity. Okay, you might not issue equity share. Instead of that, you just retain the next. But sir, amount is the amount given? No, amount is not given. But what we wrote just now, company will maintain the optimum capital structure ratio. Guys, let them raise 1 lakh, let them raise 10 lakh, let them raise 1 crore, let them raise 100 crore. What will be the ratio? It will be 15,580. Whatever amount you take, you take 10 crores or you take 100 crore. Ratio, the weights of those amounts will be how much? 15,580 only. So in the amount column, instead of amount, if I just write the ratio, will that be sufficient? You have any problem with this? Did you understand what I said? So see this statement, that's why I wrote, okay, the company will maintain what? Company will maintain the optimum capital structure ratio. What is that ratio? Yes, I'm writing now. That is 15:5 is to how much? 80 for debt, preference and equity. See, tell me now, did you understand what I said? So no, we want amount. Okay, assume 100 crore. So 15 crore, 5 crore, 80 crore. Remove zeros. How much it will become? 15 by 80. Did you understand it, guys? Understanding this concept is very important. Marginal cost amount is not given. First question that we are coming across like this, when the amount only is not given. Doesn't matter. Ultimately, it's going to be in the same ratio. Is everyone clear to what I discussed, guys? Hello, 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 hello. So putting 15, 5 and 80 will it create any problem? No. Confirm. Okay. See, when you have spare time in life, no, do one thing. Do repeat this calculation with 15 lakh, 5 lakh, 80 lakh. Multiply. Are people. Now 15, 5, 80. The weight is 100. Listen to me. 15, 5, 80, you take the weight is 100. Total is 100. You do it 15 lakh, 5 lakh, 80 lakh. What will happen? So the product will increase. No. The product will increase. The weight will also increase. 15 lakh, 5 lakh, 80 lakh, you take weight will become 1 crore. You take 15 crore, 5 crore, 80 crore. Product will increase, or okay, the weight will also increase. So ultimately, it will come to the same. So this weights I'm copying over here. Over here. Borrowing them from here. So that is 15 references, 5 equities, 8. 15 into 8.33. 124.95 plus 11.96 into 5, 59.8. 1384.75. Therefore, KO would be total product. $13.847, guys. Third digit will be 7, so make it 5. 13.85%. Come on, now you tell me. Yes, 13.8, correct. Now you tell me. Did you understand this idea? Amount of marginal capital is not given there. Amount of marginal capital addition. So what we are doing, we are just following the optimum capital structure ratio, right? Okay. Let's tackle with the next question. Part C. What is asked in part C? How much can be spent for capital investment before new ordinary shares must be sold? Assuming that retained earnings from the next year's investment are 50%. That we already know. Okay, fine. Because 50%, hello, 50% of EPS you are giving away as what? What is a, see, what is a EPS of 2070? 2.36. Less dividend would be how much? 50%, so 1.18, correct? So retention would be 1.18 per share, huh, guys? Per share. This is all per share. Therefore, total retained earnings would be how much? 1.18 into what? Number of shares. Look into the question. Don't look at me. Look into the question. Number of shares are 10,000. Old shares 10,000. 11,800. These are available for investment. Hello, people. Are you able to understand what I'm talking to you? No? You understood what I said? You understood the calculations on the screen? 2017 EPS is given, guys, 2.36. Of that, 50% is going to go as a dividend. So how much would be left? 1.18 would be left. 10,000 shares are there. So 11,800 is what is available for investment. Okay. But what is the question asked? Did you understand the question first of all? To answer. Did you understand the question? What is asked? Listen to me. Listen to me. What is asked? How much can be spent for capital investment before new ordinary shares must be sold? This is the question asked. This is not the answer. What is the question? How much can be spent on capital investment before new shares are issued? Understand, people, there are two questions in this. One is this: how much can be spent on capital investment? First the question. And the second part is this. Okay, second part is this: before new shares are issued. Means you have to put the whole question in two parts. So what does it mean? It's in our simple language, it means that is how much maximum capital can be raised. How much can be spent on capital investment? To spend first you have to raise. So that is how much maximum capital can be raised before new shares are issued. Means how much maximum capital can be raised without making any fresh issue of equity shares. Do you understand the question now? Company says we don't want to make any fresh issue of equity shares, not a single share. You understood? Company who says what? Not to issue any equity share. Huh? Listen to me very carefully. Did I say don't issue debt? Did I say don't issue preference? No, I just said that without issuing what? Equity. Correct? So company doesn't want to issue any equity and asking you how much money can be raised. So two things you have to keep in mind. Consider number one, amount of reserves available for investment. Number two, follow optimum capital structure. Got it? So how would you raise it now? You tell me. Therefore, maximum amount that can be raised without making fresh issue. See, the new plan should have what? It should have debt, it should have preference, and it should have equity. So equity is not possible, but we will use the maximum possible retained earnings. Tell me, people, number one, number two, number three. Which amount you know for sure? You know number one for sure, or two for sure, or three for sure? Number three, you know for sure. The maximum amount that you can put over there without making a fresh issue, just from retained earnings, is 11,800. Got it? Second thing, what you have to do is respect the weights. What is the best optimum capital structure? This is 15, this is 5, this is 8. Okay? So now you tell me. This is what you know, 11,800. So if you have to respect your ratio also, and you don't want to issue fresh shares also, use all your retained earnings, 11,800. Understood? And in that proportion, you now 80 is standing for this. So can you calculate the remaining two? This. You can obviously calculate 11,800 divided by 8, whatever it came to, into 15 plus 2212.5 into 5 is 737.5 into 100 is 14,007. Come on, tell me. Did you understand this? Huh? Means company says, management says, don't make any fresh issue. Okay, fine. That means then we can use retained earnings. But fresh issue equity is not to be done. Debt and preference can be issued only because you have to maintain your optimum capital structure also. So if they ask you a question like this, you calculate how much can you spend maximum on capital investment before new ordinary shares must be sold. So how much? This is our final answer. Correct? This is our final answer. We can the maximum company can raise how much? 14,750. Correct? Maximum company can raise how much? 14,750 without making fresh issue. What's it, guys? Did you understand this logic? Huh? Okay, great. Then people, one more small part is there, so we deal with it. Shall we start? Yeah. See what is told in the next part, part D. What will the marginal cost of what will be the marginal cost of capital when what funds exceed the amount calculated in C above? So without making any fresh issue, how much maximum we could collect? We said, sir, we could collect maximum 14,750. But obviously, some or the other day, company will need funds higher than this. Understood? That's what is asked in question part D. Okay, let's read that part D again. Let's hope you understand that. What will be, grammatically, what will the would be over there? What will be the marginal cost of capital when the funds exceed the amount calculated in C above? Okay. Now, the amount that is calculated in C above, 14,750. That's what you can raise without making fresh issue even of a single share. If you have to cross 14,750, then what you will have to do? Make what? Fresh issue, right? And what is written in the question? What is written in the question? That the new issue would be at 20 per share. So now what will happen? You guys tell me. The key will change, right? Okay, so let's tackle with this. Part D. If company wants to raise capital more than 14,750, then it will have to make fresh issue of equity shares. Also maintain what? Optimum capital structure. Got it? See, it's not just that you make fresh issue only and collect everything by issuing equity shares only. You follow the optimum capital structure ratio also. Guys, you realize not a single amount is given. Right? If you raise more than 14,750, what will be the K.O.? How much more? 1 lakh, 2 lakh, 3 lakh, 10 lakh, 100 crore. Whatever amount you raise, yaar, the ratio is going to remain same, 15,580. Okay, only thing what will happen, the new issue is at 20 rupees. Therefore, new KE will come into the picture, guys. New KE, that is D1 upon P0 plus G. D1 is 1.18, P0 20, and the growth is 10%. So 1.18 divided by 20 plus 0.1. It came to 15.9%. Hello, people. Hope you have understood this calculation. 15.9%. What is the only change? EPS is same. Means I mean to say D1 is same. Growth is same. Only what is expected that you make a fresh issue, then the price will be 20 rupees. Fine. So we put 20 rupees over there. So now KO, if capital is raised above 14,750, that is, what is this 14,750? That is only retained earnings. Now we are crossing that, right? So what if capital is raised above 14,750? That is only this 14,750 was only with retained earnings, guys. What I'm talking, you understand? Sure. So now what we will do? Now we'll make a fresh issue. Yes. Okay. Will we make a fresh issue? Yes. Will we maintain our capital structure? Yes. So, okay. What will be the cost of debt and preference then? Whatever we calculated in option C, that is not changing. Debt and preference cost are not changing. Okay. So let's calculate Q. Right. Source, cost, amount. The amounts would be weights and then product. So there's going to be debt, preference, new equity, capital. Let's say new equity shares. How much was our debt to cost? 8.33. Correct? Debt to cost is 8.33. Preference is 11.96. New equity will change. We take it 15.9. Means now what? We are raising money more than 14,750, and we are making issue of new equity shares, right? Okay, now you tell me what should I write in amount? Do we know how much we are raising? It is just asked to you like that. But what if you raise then more? What if you raise more than 14,750? How much? We are raising 1 lakh, we are raising 2 lakh, 10 lakh, 15 lakh. Do we know? But what we know for sure, ratio, the weights will remain same. Everybody agree on this? Whichever amount we take, the ratio will remain same, 15,580. And 4, 5, 6, 7. So you can add 14.57%. This part D is understood, guys, to all of you. What happened totally new over here? We even don't know how much we are planning to raise. Correct? Only on the basis of optimum capital structure, we have done all the estimations. Only on the basis of what? Optimum capital structure, the estimations are done. Correct? It's the 18th question over here. I don't think so. This is 18th part 2. Somebody needs 18th part 2. If you need 18th part, hello people. Somebody told me I need 18th question. In the screenshot is required, Someshwar. Everything, right? Everything. The last question, the one we solved just now. Wait. We will do it. Let me put now. Let me change the outlay. Double page. Like double page. At least we save time. I scroll to the next page. Done. Again, next page. Done. Again, next page. Done. Old stuff. $11, $12, $13. Concept of cost of retained earnings. Concept of WACC. Question 15. Question 15 continued. Then question 7. Question 14. Question 7 last working and question 14. Done. Question 18. I suppose that suffices everybody's requirement of screenshot, whatever is left out. Right, people? Done, people? Clear till here, whatever is done. Okay. Question 7 is left. No, sorry, question 8 I wanted to discuss, but that's not possible today. Fine. Next lecture, we are hardly left with 4 minutes. Other than this, if you have any doubts, I am there. Those who have nothing to ask, why? Yeah, you must be having the next lecture now. Right now, 10 o'clock now. So if you have nothing to ask, then you can leave and enjoy your break. And I'm here for some time at least. For 2 minutes I'm here till the time like anybody has to ask anything can ask. Otherwise, you leave, no problem. You need not ask for a permission. Please, please have your food so that you can attend your next lecture. Yes, lecture. Done. You're going. Leave. Don't worry. Don't leave the meeting. Leave the meeting. I just wait for 2 minutes, like in case somebody has to ask, so I just wait. Okay, people, let's put an end to this meeting. Bye, Someshwar. Bye, bye, bye. Ovia, bye, Mukilan, bye. Chalo, bye, people. Enjoy your day. Study first and then enjoy your day. Bye, bye, bye. Who's that raising the hand? Anjani. Okay.